Happy Friday, traders. This is Fawad Razakzada, market analyst for City Index. Today is the 14th of February. So the markets are quite interesting. The major currency pairs have all rallied, like the euro dollar, as you can see over here. The markets have been driven mainly because of what Trump said. And despite the fact that we've had stronger than expected CPI and PPI inflation data from the US, this has not led to a big rally in the US dollar. In fact, the opposite has happened. We've seen the euro dollar, as I mentioned, the Aussie dollar, all the major currency pairs come back against the US dollar. And it's all to do with the fact that Donald Trump was quite soft in his tone when he discussed tariffs, and his desire to end the Ukraine conflict has also helped to soothe investor nerves, causing the euro to rally. From a macro point of view, we've had retail sales data from the US, which came in weaker than expected, and that also caused the US dollar to weaken. Now, there's not much in terms of economic data from the US next week. Monday is a holiday, by the way, in the US. But we do have rate decisions from the likes of the RBA, RBNZ next week, as well as the global PMI data on Friday, details of which have all been shared with you in the link of this video. So make sure to check it out. Now, from a purely technical point of view, the path of least resistance on the euro dollar looks to be to the upside, at least in the short term anyway, following the currency pairs break above the short term trend line and bullish price action earlier this week around the 103 and later 104 handle. Now it is testing the 105 psychologically important zone, where previously it had encountered resistance. But the break of the trend line, the fact that it's moved above the 21-day exponential moving average, and the fact that we are seeing a bit of bullish price action, and that we've seen higher lows in recent days, all that suggests that a bullish breakout could potentially be on the cards. And if we move above the 105 area decisively, then a retest of that level could potentially pave the way for a run towards 106, possibly 107 in early next week. And then we'll see where it takes us from there. At this stage, the bears will need to come in decisively once again to turn the tide. I think if we move back below the shaded blue region of around 104.30 to 104.65 area, marking the highs from the previous couple of days. If we move back below that area, I think that could put the bulls in a spot of bother, but we'll cross that bridge if and when we get there. But for now, the path of least resistance is clearly to the upside. Ahead of the RBA rate decision next week, the Aussie dollar is continuing to print bullish price action. Remember, things turned around when in early February price dropped below the prior low that was formed in mid-January of around 61.31. It broke through that level but didn't hold, and that caused a bit of a false break scenario, and rates rallied to close that session higher. Since that bullish candle was formed, we've seen some upside follow through, and the Aussie dollar has gone on to break several short-term resistance levels, including this October 2023 low of 62.70, marking this level right here, which was previously obviously a major low. So the fact that we've gone above it and held above it is a bullish sign, as too is the fact that the Aussie has climbed above the 21-day exponential moving average. Now, the 21-day exponential moving average is one of my favorite short-term indicators, because it tends to react quickly to changes in the trend. And now that we're back above it, this is objectively a bullish signal on the Aussie dollar. So where do we go from here? Well, my next target on the upside was at 63.35, marking the previous support area that gave way in mid-December. We've broken through that area. So from here, it looks like 64 could be the next upside target, possibly 65 in early next week, which is the next psychologically important level. And thereafter, the 200-day moving average comes in at around 65.50. Those are some of the bullish objectives I've got in mind. On the downside, the first level of support now to watch is this 63.35 to, I would say, this level, 63.20 area, which had been resistance in the past, and it could turn into support on a potential retest. So that's a key support area to watch. If we were to go below that, then the 62.70 level comes into focus thereafter. And anywhere below that on a daily closing basis, I think that would be a bearish scenario for this currency pair. Now, I quickly want to touch on gold, because previously it was ignoring all the dollar strength, as you can see. And now the dollar has stopped rising. Gold has also stopped rising, a breakdown in its prior strong negative correlation with the US currency. It is stalling at extremely overbought levels. If I put the RSI indicator, you will see that RSI on all major time frames are at overbought levels of 70 plus. So a bit of a pullback from these levels will not come as major surprise to me. That wouldn't be the end of this gold bullish trend, of course, but it does warrant some caution. In terms of levels to watch, 2,900 is a key level now, having previously served as a bit of a resistance earlier this week. We broke above it yesterday and held above it, so a retest of that level could potentially provide a bounceable trade. But if we go below that, I think that would be interesting and could potentially pave the way for some correction of some sort. And then below that, we have the 21-day exponential moving average coming in at around 2,850-ish to 2,840 zone. But for me, the most important support area that needs to hold on a correction is this zone here. I've shaded this previously. It comes in at around 2,790, which was obviously a resistance back in October when it last hit a major all-time high. That level gave way, so a retest of this level needs to hold to keep the bullish momentum alive. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.